Roth IRA versus Traditional IRA. Which makes you richer in 2026? Before we dive in, advertisements may pop up in this video. Please, do not interrupt the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. You're 28 years old, sitting at your kitchen table at 10 p.m. on a Tuesday, staring at your savings account. There's $12,000 just sitting there, earning basically nothing. You keep telling yourself, this is the year I finally open that Roth IRA. But every time you Google it, you get hit with a wall of confusing advice. Roth versus traditional. Pre-tax versus post-tax. Income limits. Contribution limits. You close the tab and promise yourself you'll figure it out next weekend. Sound familiar? Here's the truth. The reason you're stuck isn't because you're bad with money or lazy. It's because the financial industry has turned a simple decision into something that feels impossibly complicated. That ends right now. By the end of this video, you'll know exactly which IRA type makes you richer based on your specific situation, the precise dollar amounts to contribute, and the exact steps to set everything up this week, even if you've never invested a single dollar before. I'm going to show you the actual math behind both account types, real numbers, real scenarios, and why one of these accounts could save you over $200,000 in taxes over your lifetime. No theory, no fluff, just the decision-making framework and action plan you need. And stick around to minute 16 because I'll reveal the one IRA mistake that costs people $100,000 plus by retirement, and how to avoid it in literally 5 minutes. Let's start simple. Both Roth and traditional IRAs are retirement accounts that let you invest $7,000 per year, or $8,000 if you're 50 or older. They both grow through compound interest. They both shelter your money from taxes while it grows. The only difference, and it's a massive difference, is when you pay taxes. Here's the clearest way I can explain it. Traditional IRA is pay taxes later. Roth IRA is pay taxes now. With a traditional IRA, you get a tax deduction today. If you put in $7,000 this year, you reduce your taxable income by $7,000. That saves you about $1,500 to $2,500 in taxes right now, depending on your tax bracket. Your money grows tax-free for decades. But here's the catch. When you retire and start withdrawing that money at age 59 and a half, you pay income tax on every single dollar you take out. With a Roth IRA, it's reversed. You put in $7,000 of after-tax money, meaning you already paid income tax on it. You get zero tax break today. But that money grows completely tax-free for decades, and when you withdraw it in retirement, you pay zero taxes. Not on your contributions, not on your gains, not on anything. Think of it like this. Traditional IRA is like getting a coupon today, but paying full price later. Roth IRA is paying full price today, but getting everything on permanent discount later. Let's run the numbers so you can see exactly what we're talking about. Scenario 1. The 25-year-old starting out. You're 25 years old, making $65,000 per year. You max out a Roth IRA at $7,000 annually for 40 years. Assuming an 8% average annual return, which is conservative based on historical S&P 500 performance, here's what happens. You contribute $280,000 total over 40 years. Your account grows to $1.95 million by age 65. You pay in taxes. Zero. Nothing. If you'd used a traditional IRA instead, and you're in the 22% tax bracket when you retire, you'd owe approximately $429,000 in taxes when you withdraw that money. The Roth just saved you nearly $500,000. Scenario 2. The high earner's advantage. You're 35, making $85,000 per year. You start maxing out a traditional IRA at $7,000 per year for 30 years at 8% returns. You contribute $210,000 total. Your account grows to $850,000 by age 65. Your tax deduction today saves you about $46,000 in taxes over 30 years, assuming 22% bracket. But you'll owe in retirement approximately $187,000 in taxes, assuming the same 22% bracket. Net result: you actually paid $141,000 more in lifetime taxes compared to if you'd used a Roth and paid taxes up front. So why would anyone ever choose traditional? Because some people will be in a lower tax bracket in retirement. If you're making $150,000 now in the 32% bracket, but expect to live on $60,000 in retirement in the 12% bracket, traditional could save you money. Scenario 3. The backdoor solution. You're 32, making $165,000 per year as a single filer. Here's the problem: you earn too much for a Roth IRA. The income limit for single filers in 2026 phases out between $150,000 and $165,000. The solution? The backdoor Roth. You contribute $7,000 to a traditional IRA, which has no income limits, then immediately convert it to a Roth IRA. You pay taxes on the conversion, but now you've got money in a Roth growing tax-free forever. Over 30 years, that backdoor Roth strategy with $7,000 annual contributions at 8% returns gives you $850,000 completely tax-free in retirement. Here's exactly how to decide which IRA type is right for you. Step 1. Check your income. Single filer under $150,000? You can contribute to a Roth directly. Single filer $150,000 to $165,000? You'll need to do a backdoor Roth. Single filer over $165,000? Backdoor Roth is your only option. Married filing jointly? Your limits are $236,000 to $246,000. Step 2. Predict your retirement tax bracket. Ask yourself, will I have more or less income in retirement than I do now? If your early career, making $45,000 to $75,000, and expect to earn more later, you're likely in a low bracket now. Choose Roth. Pay the lower taxes now. If you're in peak earning years, making $150,000 or more, and plan to live on less in retirement, you're in a high bracket now. Choose traditional. Take the deduction now, pay lower taxes later. If you have no idea, default to Roth. Tax rates are historically low right now. The 22% and 24% brackets we have today are likely going up in the future. Lock in today's low rates with a Roth. Step 3. Consider your time horizon. Under 40 years old? Roth is almost always the winner. You have 25 to 40 years for that tax-free growth to compound. Over 50 and starting late? Traditional might make sense. You'll likely need that tax deduction now to free up cash flow. Step 4. The hybrid approach. This is the most powerful strategy. Here's what most people don't realize. You can have both. If you have a 401k at work, it's probably traditional, meaning pre-tax. Max out your Roth IRA personally for $7,000 per year, and contribute to your traditional 401k up to the company match. Now you've got tax diversification. Why does this matter? In retirement, you can strategically withdraw from both accounts to minimize taxes. Pull from traditional IRA up to the top of the 12% tax bracket, then pull from Roth IRA tax-free for everything else. This strategy can save you $50,000 to $100,000 over a 30-year retirement. Step 5. Open the account and invest the money. Let's remove every ounce of friction from this process. Go to Fidelity.com, Vanguard.com, or Schwab.com. I use Fidelity, but all three are excellent. Click Open an Account. Select Roth IRA or Traditional IRA based on your decision above. Enter your personal information. This takes about 10 minutes. Link your bank account and transfer your initial investment. Once your money hits the account, it's just sitting there as cash until you actually invest it. Here's exactly what to buy. VTI. That's Vanguard Total Stock Market ETF. Or VO. That's Vanguard S&P 500 ETF. VTI holds over 3,500 U.S. companies. Expense ratio is 0.03%, meaning you pay $3 per year for every $10,000 invested. VO holds the 500 largest U.S. companies. Expense ratio is also 0.03%. Both have historically returned 9% to 10% annually over long periods. If you want international diversification, add 20% to 30% VXUS. That's Vanguard Total International Stock ETF. My personal recommendation for someone under 40. 70% VTI, 30% VXUS. That's it. 2 funds. Done. Step 6. Automate everything. Set up automatic monthly contributions. Go into your account settings and schedule $583 per month, which equals $7,000 per year, to transfer from your checking account and automatically purchase your chosen fund. Why? Because automation removes emotion. You'll invest consistently regardless of whether the market is up, down, or sideways. This strategy, dollar cost averaging, has been proven to beat trying to time the market 90% of the time. You now have the complete tactical playbook. So why do most people still not do this? It's not because they don't understand the math. It's because of 2 psychological barriers. Barrier number 1. Analysis paralysis. You've been researching IRAs for 6 months. You've read 30 articles, watched 15 YouTube videos, and bookmarked 47 Reddit threads. You know Roth versus traditional. You know VTI versus VO versus VTSAX. And you still haven't opened the account. Here's the brutal truth. The difference between VTI and VO over 30 years is about 0.2% in returns. That's $4,000 on a $500,000 portfolio. The difference between starting today versus starting next year after you do more research is $35,000. The cost of waiting is 9 times higher than the cost of choosing the wrong fund. Here's your solution. I'm giving you exactly 3 choices. Roth or traditional. Use the decision tree. VTI or VO. Flip a coin. Seriously, they're 98% identical. Start today or wait another year and lose $35,000. Choose one from each category. You're done. Barrier number 2, loss aversion. Let's say you invest $7,000 in January. By March, the market drops 15%, and your account shows $5,950. You've lost $1,050. Your stomach churns every time you check the balance. This is loss aversion, the psychological principle that the pain of losing $100 feels twice as strong as the pleasure of gaining $100. Here's what you need to understand. Market drops are not losses. They're discounts. When your $7,000 drops to $5,950, you haven't lost $1,050. You still own the exact same number of shares of VTI. Those shares represent ownership in Apple, Microsoft, Amazon, Google, and 3,496 other companies. Did those companies suddenly become worthless? No. Every single market crash in history has been followed by new all-time highs. The 2008 financial crisis, fully recovered by 2013. The 2020 COVID crash, fully recovered in 5 months. The solution to loss aversion? Automate your investments and check your balance quarterly, not daily. Set up your automatic $583 per month contribution, then log out. Set a calendar reminder for January 1st, April 1st, July 1st, and October 1st to check your balance. That's it. You're not someone who will invest someday. You're an investor starting today. People who have $500,000 invested aren't smarter than you. They're not luckier than you. They just started earlier. That's it. The gap between you and them is measured in start date, not intelligence. Your 65-year-old self is watching this moment right now. 10 years from now, will they thank you for starting today or regret that you waited until next year? Let's get specific based on your age and situation. If you're in your 20s, priority order. Number 1, contribute to 401k up to company match. That's free money. Number 2, max out Roth IRA at $7,000 per year. Number 3, go back and max out 401k if possible. Portfolio allocation. 90% stocks, 10% bonds. Specific funds, 70% VTI, 20% VXUS, 10% BND. Why so aggressive? Because you have 40 years until retirement. You can afford to ride out market volatility. Time is your superpower. If you're in your 30s, priority order. For a 1K to company match. Max Roth IRA at $7,000 per year. Max 401k at $23,500 per year. Portfolio allocation. 80% stocks, 20% bonds. Specific funds, 60% VTI, 20% VXUS, 20% BND. If you're in your 40s, priority order. Max everything you can 401k, Roth IRA, HSA. If you're over 50, use catch-up contributions. That's $8,000 for IRA, $31,000 for 401k. Consider Backdoor Roth if income is too high. Portfolio allocation. 70% stocks, 30% bonds. Specific funds, 50% VTI, 20% VXUS, 30% BND. If you're in your 50s or starting late, priority order. Max everything with catch-up contributions. Consider hiring a fee-only financial advisor. Portfolio allocation. 60% stocks, 40% bonds. Specific funds. 45% VTI, 15% VXUS, 40% BND. Or consider a target date fund like Vanguard Target Retirement 2040 for simplicity. Your action plan for this week. Monday. Go to fidelity.com, vanguard.com, or schwab.com. Click Open New Account. Select your IRA type. Complete the application. Takes 15 minutes. Tuesday. Link your bank account and initiate a transfer. Start with whatever you're comfortable with. $1,000, $2,000, $7,000. Wednesday. Once funds clear, purchase your chosen fund. VTI, VOO, or 70/30ths VTI/VXUS. Thursday. Set up automatic monthly investments. $583 per month equals $7,000 per year. Friday. Set calendar reminders to review quarterly. January 1st, April 1st, July 1st, October 1st. That's it. 5 days. 5 steps. You're now an investor with a tax-advantaged retirement account. 3 mistakes that cost people tens of thousands of dollars. Mistake number 1. Waiting for the perfect time to invest. Why people do this? The market just hit all-time highs, so it feels expensive. What it costs you. The market hits all-time highs roughly 30% of the time. If you wait for a crash, you could wait 2 to 3 years while missing out on 20% to 30% gains. On a $7,000 investment, that's $1,400 to $2,100 in lost growth. The fix. Time in the market beats timing the market. Start today with dollar cost averaging. Invest the same amount monthly regardless of market conditions. Mistake number 2. Contributing to an IRA, but never investing the money. Why people do this? They're afraid of picking the wrong fund. What it costs you. Let's say you contribute $7,000 per year for 10 years, but leave it as cash earning 0.5% instead of investing in VTI earning 9% annually. The invested version grows to $109,000. The cash version grows to $72,000. You lost $37,000 by not clicking buy. The fix. The same day your money hits the account, invest it. VTI or VO. 2 clicks. Done. Mistake number 3. Checking your portfolio daily and panic selling during drops. Why people do this? We're biologically wired to react to threats. Seeing red numbers triggers our fight or flight response. What it costs you. The average investor underperforms the S&P 500 by 4% annually. Not because they pick bad funds, but because they sell during crashes and buy after recoveries. Over 30 years, that behavior costs you over $200,000 on a $500,000 portfolio. The fix. Check quarterly maximum. Automate contributions. When markets drop 20%, you're buying shares 20% cheaper than last month. Let's recap the 3 key decisions. Number 1. Choose Roth IRA if you're young or in a low tax bracket now. Choose traditional if you're in peak earning years and expect a lower bracket in retirement. Use the Backdoor Roth strategy if you earn too much. Number 2. Invest in VTI or VO for simple, effective exposure to the U.S. stock market. Add 20% to 30% VXUS for international diversification. Automate monthly contributions and check quarterly maximum. Number 3. Start this week. Not next month. Not after you do more research. This week. Monday through Friday. 5 days. 5 steps. The gap between you and people who have $1 million invested isn't intelligence or luck. It's just start date. You're not someone who will invest someday. You're an investor starting today. If this gave you the clarity you needed to finally take action, hit subscribe. I release a new investing strategy video every Tuesday breaking down exactly how to build wealth without the financial jargon. And here's my challenge. Drop a comment right now answering this question. What's the one thing that's been holding you back from opening an IRA, and what are you going to do about it this week? I read every single comment, and I'll answer your specific questions there. One last thing before you go. This content is for informational and educational purposes only and should not be considered financial advice. Investing involves risk, including the potential loss of principal. Tax laws are complex and vary by individual situation. Please consult with a qualified financial professional and tax advisor before making any investment decisions. Your financial situation is unique, and what works for someone else might not work for you.